Welcome to this new edition of ARGOPulse November 2023.
Following September, investors became slightly more pessimistic, keeping a close eye on companies' performance and macroeconomic indicators to gauge the economy's trajectory. Additionally, the beginning of a new geopolitical conflict in early October has put a new threat on the financial markets and global economy. As a result, the long end of the yield curve kept rising during this month, causing a decrease in the bond market and subsequently in the equity market. In most countries, inflation is slowing down, which is a positive development for the global economy. However, there are indications of a divergence in economic growth and resilience. Indeed, on one hand, we have the US and China, whose economies are holding up well and can still generate growth. And on the other hand, we have the EU bloc, whose economy contracted during the third quarter. The main central banks have decided to keep their key rate at the current level, but continue to maintain a hawkish discourse. Investors' uncertainty about the central bank's decision over the rates level will continue to generate some volatility in the bond and equity markets, since another rate hike could have a negative effect on both. We see opportunities in companies with good financial health that are not heavily leveraged or indebted. Investing in the US is preferred over Europe due to the resilience of the American economy. The shorter end of the curve still offers better value today with not much risk and high yields. During this period of uncertainty, gold continues to remain a good asset to invest in, serving as a means to reduce exposure to bonds and equities. Furthermore, oil prices have also significantly dropped, which could be an entry point in anticipation of a rebound. Concerns about central banks tightening their policies could lead to a major slowdown of the economy because of slower demand and increased credit risk. The resurgence of geopolitical conflicts could also negatively affect the price of commodities such as oil and gas, thereby pushing inflation upward. In this context of uncertainty with weakening growth, inflation, high rates, and geopolitical conflicts, our recommendation focuses on two main investment themes this month. The world is undergoing a paradigm shift with energy transitions and geopolitical crises. Industrial producers are now faced with constraints like the relocalization of their supply chain and the use of alternative energy sources, which are more sustainable. Companies that have already started to incorporate these parameters in their production process, as well as those located in areas benefiting from government support, will be the ultimate winners in the coming years. Our second recommendation is to focus on the current macroeconomic conditions with low growth, decelerating inflation, and high rates, all whilst trying to figure out which companies are able to perform best in such an environment. Companies with a debt-based model should be avoided because they are highly exposed to high rates. Instead, we should focus on companies that can generate earnings and achieve organic growth despite lower consumption. These insights provide us with a compass for navigating the current complex financial waters. Thank you for joining us today. Until next time, stay informed and stay curious.
Contact your Lincius Partners representative to explore further how to take advantage of the current market conditions.